Hi, in this video, we'll demonstrate how to use options as a leverage to amplify one's returns, but we'll also demonstrate the risks associated with the options if you use them as leverages. So suppose we have cash at hand worth of £100, and then there's a non-dividend paying stock trading also at £100. So we have two different choices here. The first being we can just buy the share right now and hope to sell it at some time in the future. And the second choice we can make is that we can buy call options, and the call options use this stock exactly as its underlying asset. So suppose the call options are priced at £5 per option. So that's the price of the call options that we have to pay in order to purchase them. And with the strike price at £100, exactly as the price right now. And then there's some maturity. Okay, so it doesn't really matter how long it is, as long as we're synchronizing the time when we sell the stock and with the maturity of the call options, that'll be fine. Okay, so what would be the net payoffs for these two different portfolios? Okay, so we'll simplify this. Okay, suppose at time t, the ST or the stock price can either go up to £120 or go down to £80. Okay, so what will be the respective payoffs from these two different portfolios? So for the first one, if you have an increase in the stock price, and you can just sell it at time t over here, and then if you just bought the stock itself, then you have made 120 minus 100, and that's 20. Okay, and that's £20 as the profit, and then you can write it as a percentage. That's going to be a 20% return on your investment. But what about the second payoff if you chose the call options instead? So each of those call options will give you a payoff or an intrinsic payoff that is 20, right? So because you will exercise these options, you'll definitely exercise them because the market price right now is 120, but then you can buy them at 100, and then you can sell them at 120. So essentially, you're making a payoff or an intrinsic payoff from the call options of 20 each. So how many call options can you buy? You can buy 20 of them, right? Because you have £100 of cash, and then you can buy 20 of them. So each of them will give you 20 as a return. And so you have made 20 times 20 minus the 100 of the cost, which is 300 in this case. Okay? And this will give you a 300% of the return compared to just buying the stock itself. As you can see, there's a huge difference between these two, right? So if you just bought the stock, you have a 20% return, and if you used options as your leverage, you're essentially controlling or having a position of 20 stocks over here, okay, with the same cost. So your return at this point, or in this scenario, is somehow amplified in this case, right? But that's not the whole story, because you don't always have an upside in this case. You can also have a downside. So if the stock goes down in price to £80, then the first payoff is going to be negative 20 because of 80 minus 100. That's going to give you minus 20, so minus 20%, right? But as for the second portfolio, in which we have call options only, and we have 20 call options over here, will we exercise it? No, because we'll never exercise the call option if the underlying assets price is below our strike price. In this case, yeah, it is. So 80 is less than 100, so we'll never exercise them. So we'll essentially forgo or forfeit these options. But then we have paid the cost, which is minus 100, right? So in this case, our return is minus 100%, in which case we have lost everything. Our initial investment of £100 in this case. Okay, so as you can see, this the risks associated with call options is kind of huge, right? Because you cannot guarantee every time you invest in your call options or as a speculation, your underlying asset will go up as you have hoped, right? So there is always the risk of losing everything you have just invested. So there's quite a big risk in it. So it feels like gambling. Okay, so the reason we have different payoffs is that the payoff structure of our call options is non-linear. So it's not always linear because of the strike price that we have set. We don't exercise it if the underlying assets price is less than strike price, and we only exercise it if the underlying assets price is well above your your strike price in this case. Right? So remember, there's a cost to our call options as well. And in future videos, we'll deal with how to put a price on the options. And I'll see you then.